South China Morning Post, 12th of November 2022. The deal papers show that China rail loan terms against the law caused Kenya to ban road freight. China made Kenya agree to illegal and unfair terms to get the most out of her investment. Also, no Kenyan labor was used. Instead, the Chinese capital, work, and machinery did nothing good for Kenya except make a significant debt trap investment under the BRI as a threat to national security. The government must take it over. Importers had to use Kenya's standard gauge railway, SGR, to move their goods because of a deal that the country's previous government made with the Export-Import Bank of China. Kenya Ports Authority, which runs the port of Mombasa, agreed to give the SGR, which was paid for and built by China, a certain amount of cargo flow. The South China Morning Post saw the Payment Arrangement Agreement, TOPA, for the Mombasa-Nairobi SGR project. It said they would have to pay the difference from their profits if they didn't pay. This is how enslaved people and imperialists act. The railway goes from Mombasa to Nairobi, the capital, and then continues to Naivasha, a town in the central Rift Valley. It stops abruptly there, though, because China broke its promise to pay for building it to Malabar, which is on the border with Uganda. A $5 billion loan from China Exim Bank paid for the project. Former President Uhuru Kenyatta agreed to the loan just over a year after becoming the country's fourth president. The railway was built by China Road and Bridge Corporation, a China Communications construction company branch. It is part of China's Belt and Road Initiative, which aims to connect all its continents. China Road and Bridge Corporation also won a 10-year deal to run passenger and freight trains. To ensure Kenya wouldn't default on the loans, China Exim Bank developed a detailed financing plan that included an understanding that Kenya's treasury would set aside money every year to pay back the loans. Like how the Germans paid back war costs under the Treaty of Versailles. It said that Kenya would have to find enough money in its yearly budget to pay China Exim Bank all the amounts that were due and payable under the loan agreements. The agreement says that any of the terms in the contract will stay in effect until the loan is paid off in full in 2035. For the Exim Bank commercial loan, Kenya also had to buy an export credit insurance cover from Sinosure, a Chinese export credit insurance company. This cost $113 million all at once. China Exim Bank asked Kenya to set up a long-term service agreement, the TOPA, between Kenya Railways Corporation and Kenya Ports Authority and give them money yearly. Kenya Railways, the Treasury, and China Exim Bank set up a trust account where money from sales would be kept until the loans were paid off. The Kenya Ports Authority is responsible for getting freight and service fees from the train company and putting them in an escrow account. For this to work, the Kenyan government made rules to ensure that freight moved from being shipped by road to being sent by train. In 2019, importers were told to use the train for goods going to Nairobi and western Kenya. This included goods going to Uganda and Rwanda, which are close by. In December 2018, Kenya's Auditor General raised worries about the TOPA, saying that it could mean giving up control of Mombasa Port if Kenya didn't pay back the railway loans. However, experts said nothing was strange about it because an offtake agreement is routine in Chinese deals for big infrastructure projects. These are based on the fact that China took over national assets as a way to keep people as enslaved people. Kenya's auditor thought the SGR payment arrangement deal was a significant risk that the Port Authority had not told the auditor about in its financial report. The agreement means that the authority's income will be used to settle the government of Kenya's debt to China Exim Bank if the minimum load requirements are not met, the Auditor General told the Kenya Ports Authority in a letter in 2018. The KPA's assets are at risk because the government signed the document that names it as a borrower. critics raised the problem and said it was an example of Chinese debt trap diplomacy. They said China was putting too much debt on African countries, so they couldn't pay it back and were doing this to get ports and other assets. In December 2018, China's foreign ministry said, "We checked with the relevant Chinese financial institution and found that the claim that the Kenyan side used the Mombasa port as collateral in its payment agreement is untrue." In April of this year, scholars from the China-Africa Research Initiative at Johns Hopkins University, whom China influenced, said the claim was false. They noted that Kenya had not used the assets of Mombasa port for security but instead used the port's profitability, flexibility, and overall financial strength to support the SGR project. Deborah Broidegam, a professor of international political economy at Johns Hopkins University and the founder and director of the China-Africa Research Initiative, was in charge of the project. It found that the take-or-pay agreement system let the Kenyan government make a project that could be financed, even though the leading project owner, Kenya Railway Corporation, lost money. The study said, the SGR project was carefully and creatively built to lower the risks of a sovereign default and improve the bankability of a project that will benefit Kenyans now and in the future. The profitable Mombasa port was linked to the SGR project as its main customer, instead of being used as security for the loans. The port's only job was to help its owner, Kenya Port Authority, ensure that a certain amount of cargo got moved between Mombasa and Nairobi, Kenya's leading city in the middle of the country. The study found that the Kenya Ports Authority used its money to make up the difference if cargo levels fell below that level. However, the study also said that KPA faces a risk to its cash flows, not its ports. However, the Port Authority might not have reached its goal because President William Ruto kept an election promise to move goods from Nairobi or Naivasha to Mombasa for unloading instead. This was to save money and stop China from forcing its will on the people of Africa. Kenya's government told the bank that the 2% railway development levy on all imports will act as insurance in case revenues under the take-or-pay arrangement fall short of the amount needed to service the loan. Kenya has made an irrevocable agreement with China Exim Bank that the money its railway company put into or transferred to the escrow account will be paid back. It is required that the report always has at least $250 million in it. Parties to the deal agreed that if there were a dispute that both sides couldn't solve, it would be sent to the China International Economic and Trade Arbitration Commission in Beijing to be settled. This is similar to how the British colonizers paid all cases in Britain instead of the local courts where the people lived.